Iya. Sekejap.
Hello everyone, and thank you for joining us. We are MBS Academy. Our mission is to bring digital technology close to all professionals. We teach business professionals how to use digital technologies and manage digital risks to be familiar and comfortable with them. Some of our programs include foundation.
Hello, Tony, we can't hear you.
Hi, did you hear anything?
Yeah. Sure, go.
There are few members of our team with us. Jason?
Hello, everyone. I am Jessa from Manila, Philippines, and I am the producer of the online session.
Metene?
Hi everyone, I'm Medini from Malaysia and I'm in charge of the polls today.
And Mario.
Hi everyone, I'm Mario and I'm one of the trainers and presenters at MBS Academy.
Thank you. In this session, we'll be talking about positive operating cash flows. And our speaker for today is Dr. Grace Mui. Grace is a chartered accountant and a certified internal auditor. In 2010, she was awarded a PhD accounting from the University of Queensland, Australia. She is an HRDF Malaysian Ministry of Human Resource certified trainer. And before to start, I would like to remind you that your videos are on, so keep in mind that we can see you. Grace, please take it forward.
Thank you, Tony. Okay, let's share. Let's have a look at, a big issue that we have nowadays with the pandemic is how to get inflows, cash inflows into our business. And it's quite interesting listening to different experts talk about the business issues, the main problems that face business nowadays. And they tend to talk about revenues and expenses. But at the end of the day, if there's no cash flow, then you can have all the revenues in the that you can achieve, and you can minimize your expenses. But if no cash flow is coming into your organization, then there is a very big problem. Before we talk about positive cash flows, let's talk about operating cash flows. Operating cash flows are the bulk of the cash that flows into the business. So this cash is generated when a business conducts its normal trading activities, whether it's a provision of services or actual products. Now, when we talk about positive operating cash flows, this is a situation where cash inflows exceed your cash outflows. And when you have excess cash inflows, you can then sow it back into the company so that you can grow the business operations. And the primary source of operating cash inflows is collections from customers. And this is where you have sales. And when you have sales, you can have sales on cash terms where customers pay you upfront. So cash inflows are immediate. But more importantly is something called sales on credit terms. Usually companies offer sales on credit terms to increase the amount of sales. It's an incentive for customers to buy first and pay later. But with that, there is the risk of not receiving the full amount of the sales. Now let's do a very quick poll. And the poll question is, in 2019, how much time on average does it take for your company to receive payment from the customers?
Hi everyone, you're going to see a small poll pop up on your screen. If you do not see it, please let us know in the chat box. All right, we're going to end the polling now.
Right. Now, what you can see is in 2019, 50% of you mentioned that it takes 2 to 3 months to receive payment from your customers. And in the worst case scenario, it's 6 to 12 months. Of course, the best case scenario is always 1 month or less. Now, let's go on to the next poll question. Bethany, whenever you're ready. So in the first 4 months of 2020, how much time on average does it take to receive payments from your customers?
You should see your next poll pop up on your screen now. If you don't see it, please let us know in the chat box. All right, thank you for participating in the poll. You should see the results on your screen now.
All right, and we noticed that it's still 2 to 3 months on average. However, the number of participants who mentioned that has dropped from 50% to 42%. And it looks like there are more customers paying between the 4 to 12 month period. So even the 1 month or below period has actually dropped. Now let's continue. Now, when we talk about positive cash flows, how do we manage cash flows? When we talk about positive cash flows, the focus is actually on getting your customers to pay your business much faster than they normally do, right? Especially during this pandemic when the payment received from the customer seems to have slowed down. And there are 2 things that we want to look at. One is receivables, and the second is something called days receivables. Now, receivables is the amount customers owe the business from sales on credit terms. And this receivables figure is at one point in time, let's say at 31st of May 2020. So at that point of time, how much do your customers owe you? Now, the second thing that we want to look at is sales. So sales is the amount that you actually sold to the same debtor during that period of time. Now, sales is recorded over one period of time. So it's not at one point in time. So there's a difference between receivables and sales. Now, when you talk about receivables and sales, receivables should be a proportion of sales. That means receivables should generally be less than sales unless your debtors owe you from the year before. Now, in that case, you shouldn't be selling any more goods to them. Now, days receivable is a calculation that takes into account both receivables and sales. It actually tells you the number of days it takes to receive cash from receivables. So the number of days for the cash inflows from receivables to get into your business, to enter your business. And this formula is a very simple formula. It's a 365 days in a year multiplied by receivables divided by sales. Now, when we apply data analytics to positive cash flows, okay, what we have is we have this basic formula. We know that there is a relationship between receivables and sales. Receivables divided by sales means that receivables is a proportion or a percentage of sales. And when we multiply receivables divided by sales by 365 days, we are looking at the timing, the number of days it takes to receive the cash inflows from your debtors. Now, data analytics focuses on relationships. So in this case, when we talk about positive cash flows, it's the relationship between receivables and sales. Let's have a look at the Excel case study. I will show you what data scientists actually do, and I will use Excel as a tool because Excel is easily accessible and it is available in most businesses. So if you look at this Excel spreadsheet, what we have here is a data summary at the 31st of March 2020. And we have a list of customers and the receivables at the point in time, 31st of March 2020, and the sales for the first quarter of 2020. So from 1st of January.
Excuse me, Dr.
Yes.
Grace.
Yes.
Can you share your screen with Excel, the window with Excel?
Okay, okay.
We don't see it.
Let me try again. Huh? Can you see it now?
Perfect.
Okay. Yeah, so we have this data summary at 31st of March 2020, and we have a list of customers, and all of them are debtors, meaning customers who buy on credit terms from the company. So you have your receivables, which is the amount that they owe. These customers owe the business at 31st of March 2020, and the sales for the first quarter of the year, so from 1st of January to 31st of March 2020. Now, as you scroll down, as I scroll down, you will see that there are actually 50 entries. And we have a total of the receivables and the total for our sales figure. Now, whenever we have data, the first thing a data scientist will look at is the descriptive statistics. We want to look at the data, look at the characteristics of the data. So the description of the characteristics of that data. And we will look at the description of sales as well as receivables. So let's start with receivables. We will use some basic Excel formulas. For example, to calculate the minimum value of receivables, we will use the equal sign, which means that you are now going to enter a formula. And we are going to look at the minimum amount of a range of values. So the range of values will start from cell C3 and go all the way down to cell 52. Now, when I press the enter key, this amount will appear. And what I'm going to do is I will now lock some parts of the formula. The formula, if you look at the formula in the formula bar, it's stated as equal, minimum, MIN is minimum, for the range of cells from C3 to C52. And if you look, there is a dollar sign before the number 3 and a dollar sign before the number 52. Now this means that we will lock the cells in terms of the rows in column C. So this is column C. And we will only be looking at the cells from rows 3 to 52 in column C. Now, we can copy this formula over to the maximum value formula, column cell, and we change this to maximum. So in the earlier formula, you see you have the minimum, and now you have the maximum for the same range of sales. Now, the next thing we want to do is calculate the range. So we want to look at the difference between the maximum and minimum to find out how spread out our values are. So once you know how spread out your values are, in this case, it's 21,000, close to 22,000, then it shows you that, now if you compare that with another set of receivables where the range is 50,000, then you will realize that the narrower range shows that the receivables values are closer to each other. So if it is too widespread, that means, well, maybe too many people owe you money. So that's not too good for the business. Now, the next thing we're going to do is, now before we can make conclusions about that, we will need to look at the average, which is the mean. Statistically, it's called the mean. Now, it is the formula, actually average. You use the average of the same range of cells, and we will look at the median. The median value is the center value. It's in the middle of all the rate of all the values. Now, that means it is between points 25 and 26. So data number, if you rank the debtors in terms of the highest to the lowest or the lowest to the highest, they will be in the middle. The value will be customer 25 and 26, right? Now, average means the total receivables divided by the total number of debtors. Now, using these formulas, this set of formulas, we can copy them over to the sales descriptive statistics column. Now, earlier we saw that with a minimum figure, with